let's talk about risk management. Any signal group will always tell you to place a trade and so, right? But at the end, they will always tell you apply risk management. Some of us don't know what this means, okay? They just go ahead and place a trade without any risk management tool. You understand? And they end up making profit, but while they sleep, they end up losing everything. Okay? And even go ahead to weigh them down in a way that they will finish their money in just one night. Okay? So, risk management is crucial. So, here I'll tell you what risk management means. Risk management involves the strategies used to help control or reduce financial risk. Okay, I repeat, risk management involves the strategies used to help control or reduce financial risk. Example of risk management is the stop loss. Okay, stop loss. So let's talk about stop loss. Stop loss is an order. Okay, a stop loss order is a risk management tool allowing a position to be closed once it reaches a specific preset price. I repeat, a stop loss order is a risk management tool allowing a position to be closed once it reaches a specific preset price. This can protect against further loss on an open position if price continues to depreciate or appreciate. Okay? When I mean depreciate or appreciate, I mean if price continue to go in an unfavorable direction for the investor. Let's say you place a buy order, okay, and you expected the base currency to start buying, right? The value to increase, right? To rise. But unfortunately for you, the price starts depreciating. Like I said, we use the word here, depreciate, right? For some people that placed a sell order, yes, they are making profit, right? But you that placed a buy order, you are losing money. And if you allow this to keep depreciating, it might finish your account, okay? And why it's good to set a stop loss is because when you want to set it after the price has started going down, sentiment will come in. So you don't want that. So you set it immediately you are placing your buy or sell order. Okay? Now, if the price now is going unfavorable to your expected direction, the stop loss will automatically cut off the market. Okay? Will take you out from the market with the loss you have acquired already. You understand? So with that, you can still have some amount of money in your account without blowing up your whole account. Okay? Also, if you place a sell order and it start appreciating, it's also a problem for you. It's unfavorable for you. So the stop loss will still help you take care of that. Okay? That is why it is so important. You might be sleeping while all these are happening, but immediately, you don't need to be online. Immediately, the price gets to that level, it's cut off automatically for you. Okay? But anything that has advantage has disadvantage. Let's say the market hits your surplus and few pips it starts retracing. Know that you are no longer in that market, okay? Because you have already been shot out of that market by your stop loss. So you won't benefit the retracement. So you won't benefit from the retracement, okay? But do ensure to apply risk management. So right now, let's talk about take profit. Take profit order is a risk management tool also, allowing a position to be closed automatically. I repeat, take profit order is a risk management tool allowing a position to be closed automatically once it reaches a preset profit goal. What is a preset profit goal? The expected profit you want from that open trade. Okay? This can protect against profit being lost in an unanticipated reversal of price direction. I repeat, this can protect against profit being lost in an unanticipated reversal of price direction. Okay, let me explain this. Let's say you traded GBP to USD. That means pounds as a base and USD as a quote. That means, and you place a buy order, right? That means you are expecting the price to appreciate, right? To rise. But yes, of course, when you open the trade, it started going the direction you wanted it to. And it gets to a place, it started reversing. Okay? Meaning, if it's reversing and you did not close the order, all your profit will reverse with it. And sometimes it might even go further, wiping your account, blowing your account, especially while you are asleep. A lot of this happen while you are asleep, okay? But with this take profit order, you set your take profit at some people, let's say 50 pips above where you bought, okay? That means automatically when the price reaches that value, it shot you out from the market with your profit intact, okay? Meaning you have made your profit. But if you don't set it, it goes against you, my friend. You have yourself to blame. You understand? But also, as I told you, everything that has advantage has disadvantage. Let's say, now, let's take this illustration. If the market was going 100 pips and you set it, your take profit at 50 pips, immediately it takes you out of it, the remaining 50 pips, you are not involved. Okay? Meaning the door is shut against you already. But your profit you made is still intact. But there's a wise saying that says, half baked is better than none. It's better you have something than you lose everything. Okay? Always apply risk management. Okay, now let's talk about margin and margin call. Margin is simply the minimum deposit needed to maintain an open position. I repeat, margin is simply the minimum deposit required to maintain an open position. Let's say you open a trade, and for you to be able to be in that trade, the market must not go against you, okay? Otherwise, there's a level that it will fall to, then you will be notified that you are below the margin, okay? And this is not good for any trader. And that is called the margin call. Margin call occur when your broker notifies you that your margin deposit has fallen below the required minimum level because an open position have moved against you. Let's go again. The margin call occur when your broker notify you that your margin deposit has fallen below the required minimum level because an open position has moved against you. All traders are afraid of the margin call. Okay? So, whatever you do, make sure you run your analysis right so that immediately you trade, you start entering the profit side and not the negative side, all right? Because the more you go to the negative side, the closer you are to receiving the margin call.